So deal at last. We might do a separate video in terms of hedging in oil and why is it that Mexico refused to budge. But for now, 9.7 million barrel per day cut in terms of what we know so far, and that's for the first couple of months effective May, and then for the second half it'll be down to 8 million, and then until April 2022. That's significant in terms of the timeline, 6 million. So why is it that we're hearing up to 20 million barrels per day? Well, that's because if you take into account the fact that April's production increased due to the oil price war, that's effectively 12.5 million reduction out of OPEC plus countries. There's also, according to reports, you got commitments from non-OPEC plus countries for 4 to 5 million, as well as IEA considering purchases of up to 3 million over the next couple of months. Now, why is it then that oil prices haven't surged? Well, from a speculative standpoint, when traders hold extreme long bias, a lot of times the market tends to shake out those longs first, either oscillatory moves or even makes, flirts with lower lows in sort of entice shorts into initiating before making a move higher. But let's put aside speculation, let's put aside trading, let's stick with the fundamentals for the moment. And you can see that one of the reasons why is because demand has plummeted by even more than the proposed cuts. Second of all, you got compliance from 23 countries whose budgets are about to get severely tested over the coming months, if not years. You also have potential second or third waves that are likely to dent energy demand, as well as the fact that the theme after COVID-19 is going to be debt, default, and deferment. Now, what about the week ahead? Well, it starts off with mostly low impacting items. We do get API's oil inventories estimate Tuesday night, our time, but as of late, the estimate has been showing surpluses less than that of EIA's on Wednesday. That's going to be preceded by plenty of U.S. data, including retail, as well as the Bank of Canada's monetary policy announcement, where its key rate is already at 0.25%, already initiating QE. Not much room on that front. Now, on Thursday, focus shifts back to U.S. unemployment, and that's because unemployment claims last week was at 6.6 million again, whereas on Friday we get a string of data out of China, significant because they're the first to get affected and potentially the first to recover. We also get Baker Hughes U.S. oil count, which last Friday showed a significant decline, a theme that's likely to persist should the energy commodities price fail to lift itself off the lows. There's also going to be Q1 earnings throughout the week. Keep that in mind because they're expected to disappoint big time.